Well, welcome to another update in the economic long wave. This one is going to be about Toronto. And I know about Toronto very well. I've grown up and spent most of my life, if not all of my life, here in the city. And it's unfortunately a story I need to tell, but it's a massive real estate bubble. And I found this graph, which is actually perfect to illustrate the problem that we have here. Okay, so a little bit of a background. I think it's important to tell you this story. This is well, you can see very clearly, this is Toronto's nominal average home price from 77 to 96. And why that story, or this story, is important, right? Every chart has a story to tell. And we need to decode what is that story. Well, this story is really about myself because what you can see there is that real estate prices peaked in 1989. That's where this story with myself starts. In that, remember this to this day, February 14th, I proposed to my wife at the time. That was a Tuesday. And that Sunday, we purchased a condo because as of now, a lot of people did the same thing. There was a lot of, get a lot of the glare there, panic buying in real estate. And simply that was occurring because of the asset bubble. Now, what caused that bubble was simply real estate had this fantastic tailwind from 1984. From 1981 to 84, interest rates collapsed. And that, at the time, was the beginning of the monetary wave. And the monetary wave is when the price of credit falls, and it starts the process of asset bubbles because people don't look at how much the home costs is how much they can carry every single month, if that makes sense, right? I will do a video on the long wave, but remember the monetary wave. I'm going to mention this a lot. The monetary wave fosters Ponzi finance, which is an unsustainable, unproductive asset bubble predicated on cheap credit, which fell for 40 years, from 1981 to 2021, for about 40 years. Because if you're aware, no asset bubble or credit bubble really occurs in other parts of the long wave. But as you can see, it peaked, and that collapse in real estate prices devastated my finances. Because in the same year, that fall in 89, I actually became a financial advisor. And it was an eye-opener about, and I learned very quickly about the errors in what I made. But because I started as an advisor, I can smile now. We couldn't declare bankruptcy, and we basically had to pay all that debt. But what saved us was the collapse in interest rates. And that's the concern I have now for this asset bubble, because how do we soften the blow? But anyways, that was a collapse, and prices fell about 25%, and it wiped out all the speculators. So, you know, when people says, well, they're a real estate expert. Well, I don't think you're a real estate expert unless you've gone through a bear market. In the financial markets, nobody can claim they're an expert unless you've gone through a bear market in the stock market or a bear market in real estate. That is, very important. Now, I found these clips, which is really interesting, articles from the time. And what's interesting is that you can read that the same thing that was occurring today. You can see this was from the Globe and Mail in February 1990, just about a year from the peak, but still the psychology was really strong. And I've highlighted there in red, this is however a growing proportion of real estate in Canada has entered in world-class category. It's just justifying asset inflation. So now, I know because this is a video, you can stop and start it, so I don't have to worry about going too fast or too quickly. But really, I've said I wanted to do this to educate in small bites, because I know this is overwhelming, and I've said this, red pill you slowly, right? The long wave is, I spent 35 years unknowingly at the beginning trying to understand how things work, right? Because the long wave is a representation, it's a theory, and I don't think it's a theory of how things actually work, how the economy works. It's not how we think it should work, like Marx or Keynesian, how it actually works. So it's interesting. Now, also I found another one, and this one's actually even better if highlighted. And if you look at, the same issues were happening just actually before the bubble peaked in 89, housing crisis, land short supply, but we had Ponzi finance. Now, at the bottom, again, I know you could read this, you can stop it later, but it says here that there are a few contrarians, and I'm one of those now, and I wish I was aware of this back then, that argue Toronto's real estate is bound to burst. And they conjure a continent-wide and estate collapse because of the same demographic trend that fueled housing for a long time as the baby boomers sprout gray hair, they no longer drive the market. And that came to be true. The demographics came to an end in 1991, and it was also rising interest rates that pricked the bubble. So, but, which you'll see later, this is much larger than 89. That market was overvalued by 25%. Yeah, Toronto today is overvalued by 75%. Valuations in time will be corrected. You can guess how I think that's going to occur. Whether you agree with that or not, you'd always get people telling you, oh, that can't happen. You know what would happen if that actually happens? Look, I'm here to, pass on what I've learned about markets, and then they fluctuate in and around inflation and incomes. Incomes are the long-term determinant price of an asset, especially real estate. So we're here to inform you. Whether you want to accept it or not, it's another story. This is Toronto median income, individual income, of course, in constant dollars. I found this on Stats Canada's website. And why this is interesting to me, if you take a look at the green line is the trend, has been a downward trend. So basically, there's been no income growth. Now, I find this fascinating for somebody like myself. It kind of gives you my age, but I was a busboy in 76. Loved that job. And it was in high school. So think of it. Since 1976, the average person, after inflation adjusted with this fiat system that we have, your incomes aren't any higher. Yet asset prices are dramatically higher. How is that possible? Right? Unless you have rising incomes, real estate is more than just supply and demand. That is, I have to say, the most ridiculous statement about real estate, that, supply and demand drives. No, it doesn't. Affordability does. If people can't afford to buy a home, prices won't go higher. And the only reason, again, the only reason asset prices have gone up since 96 is because the price of credit allowed more and more people to leverage into the market, and that now has come to an end. This is the reality. Sure, there is demand, but if that demand cannot afford it. Now, what's happening today? We're seeing the opposite happen. We're seeing interest rates rise, and 30% of those that own homes are technically defaulted. That means 30% cannot afford their home. So affordability is the bottom line. If they will default eventually, and then what? That will collapse demand dramatically. So this thesis, just supply and demand, is very weak analysis, and it's dangerous to articulate to people. With immigration that is going to save a bubble, they have to afford it. They have to have a job. They need to have savings. They need to have some capital. They need to know where to live. But there's always a story to justify an asset bubble. But again, that chart, look at that chart again. No real income growth since 1976, the disco era. What does that tell you? Now, I found another one that's a little bit more updated, and you can see from 76, and this is in 2018 dollars. And okay, so real incomes rose 15%, but real home prices rose 512%. How is that possible? The population growth is not the reason of population growth. We didn't have the inflation growth. What's the answer? The monetary wave. The price of credit has fallen, making or allowing quasi finance. And that started to reverse when interest rates went up. And that's what I've said. I've said that this secular bull market in real estate is over. So again, how is that possible? Now, if you look at, here's Toronto home prices, inflation adjusted in 77, and you can see it was pretty much flat from 77 till about 85. And 85 is important because interest rates just collapsed from the peak in 81, and that's what caused asset prices to triple. That was the peak, and then it bottomed in 1996. And you can see I put two fair value bands there. Now, I know what people are going to think. That can't happen. That won't happen. They won't allow it to happen. Impossible for that to happen. No way that's going to happen. Give me reasons all why it won't. History says it will. In time, it will correct because the ability to carry mortgages and that value. Because if you take away the mortgages or interest rates, or when interest rates will skyrocket in the future, and that's another story, that will put the end to all the speculation. Okay, so, inflation and incomes are historically where real estate prices long-term settle in and around. It goes above it, as we've seen in 89 and up until 2022, and it's going to go below that. In time, probably we'll be running to a secular bear market starting next year into 2040, more than likely. And again, this is information, factual, historical, accurate information about the past. There is no thesis or theory. So you can look up, and again, I'll do this in the future because I want to keep it to a minimum or keep this thing short. Here's another way, and I've just calculated, took the home prices to income, both inflation adjusted from 76 up until June. And you can see when you measure that, and I have this red line, and I say this is phantom wealth since 2001. Prices rose simply because of cheap credit. There's no other reason. It's not population growth. It's not inflation. It's definitely not earnings. And that's why, they peaked at 17.8 last year. And fair value is about 3 to 4 times income. From 1946 until 71, it was about 2 times income. That's why I said the secular bull market from 1946 is over. It's just extreme. Now, I forgot to put this up there, but my mentors, Peter Kundal, one of the greatest value managers, used to talk about that valuation, and in this case, debt, because we have extreme debt levels, are a measurement of risk, not timing, right? It doesn't tell you when it's going to pop. You need to look at or be aware of other indicators, but it's a warning that, hey, we're going to get a systemic collapse, and we're there. And it's going to be a painful one when the remaining secular bulls give in and they start to panic. That will be the start of the great bear market in real estate. So you can see very quickly, and understand a little bit of my background and how I've come to a conclusion. And I've said before, I want to educate people with short videos, right to the point, educate them about the long wave and some risks. Now, ask me if there's any kind of questions, because I'm going to do maybe 1 or 2 a day, keep them short, educational, informative. And then I'm taking the questions and using on the next video. If you want to follow me, I'm at the economiclongwave.com. I'm on Twitter, and all my social media is there. If you want to have access to a model that I developed when I was managing capital, is there. Subscribe to the Substack account where I get into the model. Obviously, it's super bearish for real estate, and I can't give away, this model, by the way, I developed for myself. And it'll prove itself as people use it. And a lot of people have already been using this since I've launched 2 months ago. So, yeah, follow, like, pass it on. Oh, one more thing very quickly. If you know somebody that is hurting and regarding real estate, have them follow me on my website. I will be informing these people. We'll be having education meetings, Zoom meetings, if you want to call it, to help them go through the crisis. I'm one of the few experts that went through it personally. I know what you're going through. It devastates your family, devastates your finances, devastates your dreams, devastates everything. And so I'm one of the few that can help you through that process, because if you heard my story, I bought at the top and it disrupted my life. So from that, I can help you through that, right? I can work with your advisor, your accountant, whoever you want, your family, and we'll give you insights, right? All I can do is educate you what you can do to make a better decision. And so it won't be as bad. The outcome won't be as bad financially to your family and so forth. So, or pass this on if you know some people. And once I have enough names, we're going to contact those people and let them know when we have that meeting. So anyways, hope this was informative, educational. I'm going to be doing this more often. I set up an office here with all this high technology so I can do this at a high performance level, short to the point, educational, informative, and helping you through economic winter, surviving economic winter, right? It's not our fault that society leveraged up again. And now we're in the process, probably next year, starting to deleverage. What's the opportunity? How do we take advantage of it? How do we build the conjunctive fifth wave, the decentralized renaissance? That's why I'm doing this, is to help us get Canada through this and through this disruptive period. Thanks for watching. Hope it was informative again, and we'll talk soon. Bye.